Next year, who knows? We'll get into that. But again, that's going to be something that we'll be looking into early next year, starting to kind of lay out the roadmap for what the investing portfolio needs to look like next year, because things are going to change. What did really well this year, what did really well last year, typically doesn't do well in the following years. This is one of the big problems of investors. They continue to chase what was hot last year. Markets rotate, sectors rotate, asset classes rotate. So again, what worked well over the last couple of years may not work well next year. And let's talk a little bit about what you know before the bell this morning. Markets are doing what they do this time of year, starting to rally. Markets look to point up a little bit this morning. Dow's up a smidge. Market S&P's up a smidge. Now, everybody's already starting to say, well, maybe Santa Claus isn't coming this year because, markets have been trading sloppy. We're not at the Santa Claus Rally yet. Santa Claus Rally is the last 5 days of the year, last 5 trading days of the year. So that will start later this week. And then the first 2 trading days of January. So again, we're making a prediction that Santa's not here yet. Yeah, he hasn't come. It's like saying, well, this is the 22nd. I don't have any presents from Santa under my tree. Yeah, he doesn't come till the 25th. So, the market Santa Claus Rally not here yet. So just patience, people. The good news is that the last 2 years, right, Santa Claus didn't come to Wall Street, right? So we had 2 years in a row where Santa didn't come to Wall Street on the last trading days of the year. It also did not mean that those 2-week Decembers were bad years for the markets, because obviously they weren't. But here's the interesting stat. There has never been, ever, on record, going back to 1950, there has never been 3 years in a row where Santa Claus didn't visit Wall Street. So I'm not, this could be the first year, but just statistically wise speaking, kind of all the odds are still there. So again, we're not there yet. For everybody predicting we're not going to have a Santa Claus Rally, we're not there yet, but that starts later. But outside of that, the market has been doing okay over the last few days. We had that bit of sell-off last week, and we had 4 days of that decline, and that certainly put some pressure on the markets near term. But since then, the markets have rallied nicely back up above the 50. They broke the 50-day moving average. Lots of concern about that. So, oh my gosh, we just broke this support. Like we said last week, be careful of that. When markets break support initially, don't knee-jerk react to that, because there's a lot of algorithms that are hunting that 50-day moving average. So they're pushing the price down. They're trying to flush all the people that have stops set at the 50-day moving average. They flush all them out, and they come in and start buying the market. So never buy the initial break of a moving average. Be patient, because what will happen is those algorithms will start buying, and they'll start pushing the stocks back up. It's exactly what happened. We broke the 50-day moving average, and then we reclaimed that on Thursday, and then on Friday got above the 20-day moving average. So those breaks of that support were immediately reversed. And now the markets are set to point up a little bit this morning. So we'll see how this works out. But again, right now we're still consolidating. Have just been trading with this big consolidation range. And it's been frustrating. A lot of people are like, oh my, this market's just not doing anything right now. Hey, I get it. But we're just been consolidating that huge gain we had since October, from that April low. And money flows have got a little bit weak here during that sell-off. They started to turn back up here a bit. We've turned relative strength back up here a bit. If we can rally a bit, we should be able to turn that momentum signal back onto a buy signal as well. And that would be supportive of that year-end rally. Now remember, as we were coming into December, we said, hey, be aware that the first couple of weeks of December tend to be weak because of mutual fund distributions, those type of things. And that's exactly kind of what happened. And now we're kind of set up now for that year-end window dressing. So again, I know there's a lot of kind of concern right now about markets, but overall markets are doing okay. We're going to have a good year this year. We're going to probably finish the year around 18-19% on a total return basis. Certainly has not been a sloppy year. It's been a volatile year. We've certainly had a lot of volatility. That April decline, we had the sell-off going into November. We had this little recent sell-off here just recently. So it's certainly been some volatility. But overall, the market returns have been very, very good this year and very broad. We pretty much every asset class, for the most part, has made gains this year to some degree. So overall, regardless of where you had money invested, you made money this year. Congratulations. That's the whole goal of investing, is to make money. It doesn't matter whether it's, metals, or if it's the markets or wherever. Pretty much every single sector, market, and asset class has made money this year. So again, this has been an easy year to make money. Some did a lot better than others, but that's not, who cares? This isn't a competition. It's about making money. And so how you were invested, how your portfolio did, is a function of how you were invested this year and how you manage the volatility risk. And again, for most people, they made money this year, and that's good, right? The whole purpose here is to grow wealth and preserve the purchasing power of your investment dollars over time, and this was certainly a good year for that. Now, next year, who knows? We'll get into that. But again, that's going to be something that we'll be looking into early next year, starting to kind of lay out the roadmap for what the investing portfolio needs to look like next year, because things are going to change. What did really well this year, what did really well last year, typically doesn't do well in the following years. This is one of the big problems of investors. They continue to chase what was hot last year. Markets rotate, sectors rotate, asset classes rotate. So again, what worked well over the last couple of years may not work well next year. So again, that's something we're going to have to start looking at as we get into early next year, starting to see how market dynamics are lining up, and start looking where investment dollars may be needing to go to next year, because what worked before may not work in the future, because markets change, narratives change, all those type of things occur. So that's going to be really important to make sure we get a good grasp of that at the first part of 2026. And we'll be working on that with you right here on the Real Investment Show. But that's what you need to know before the bell this morning.